With home unaffordability at all-time highs, everybody and their mom is trying to come up with a solution to this crisis. And one of those ideas I heard from Graham Stephan, who's promoting the idea of portable mortgages, which is also something that the current administration has said that they're actively looking into. Here's a clip of Graham talking about this idea.
They should also allow you to take your existing mortgage with you and apply it to the next home, assuming you're trading up on a primary residence. And this would also unlock a lot of lower-priced inventory.
The theme of my real estate videos recently has been everybody says they want affordable housing, but they don't want their home to become more affordable. So in this video, we're going to talk about one of the issues leading to high home prices, which is low inventory. And then we're going to evaluate portable mortgages to see if that's a viable solution to this crisis. And then at the end of the video, we're going to look at why volume gaps in any market can lead to lower prices, which in this situation is actually a good thing. Okay, we've got to start with the problem occurring right now in the housing market, or at least one of them, which is that there's not enough transaction volume. Like there's just not that much available inventory. However, with any government solution, there are drawbacks and things that we need to consider. In my video titled, Yes, Home Prices Are Too High, I talked about how the biggest culprit for the affordability crisis we're currently facing is the federal government, also the Fed, but mainly the federal government. And this is the pattern of government intervention in any market. It creates winners and losers, and unfortunately, if you're at the bottom strata of the economic ladder, you're usually the loser. And although that's most of us normal people, we keep getting the short end of the stick, we ask government to fix it, and then we get an even shorter part of the stick. And this idea of mortgage portability is no different. It will create winners and losers, and if you're currently losing, that means you will probably continue to lose. But I do want to give Graham Stephan a few props here, because this idea is more unique than the drones in the media saying we need more supply, we need interest rates to come down. Okay, before we talk about mortgage portability, we need to talk about the problem it is seeking to solve, which is low available inventory and low transaction volume. During the COVID years of 2020 and 2022, there were a lot of home sales, and as you can see from this chart, as mortgage rates started rising in early 2022, transaction volume fell off a cliff, and for the last 3 years, the real estate market has been in gridlock. There just haven't been that many transactions. And so this idea of being able to take a current low interest mortgage with you is trying to solve this problem of low available inventory. Basically, if you bought a house before early 2022, you either refinanced a mortgage to 3% or you bought a home and your mortgage on that new home was about 3%. So when current homeowners look into the market when they decide it's time for them to move, they're shocked when they discover that buying their own home would cost them 30% more per month because of higher interest rates. Okay, let's look at a very simple example of how this works in practice. Let's say a home is worth $400,000 and someone bought it back in 2021 with a 2.875% interest rate. Their current monthly payment is at $2,400. Now, if they were to buy that same exact house with no price appreciation, but their interest rate was 6.25%, that monthly payment jumps up to almost $3,200. On top of that, if you add in the fact that a lot of these homes have increased in value, you can see how high interest rates have made homes so unaffordable. And because of this phenomenon, when current homeowners look into the market and realize how expensive things are, both from a price standpoint and a monthly payment standpoint, they decide not to move, to stay put. And this is what creates the lock-in effect. The lock-in effect observes a large portion of the homeownership population that don't have to move but would like to move. That portion that can technically stay where they're at decide not to move because it is just so expensive to buy something else. And the lock-in effect observes a purely financial motive. Obviously, people do have to move, whether it's for a job or downsizing, or maybe you need more space, or a variety of reasons kind of trump any financial reason. But the lock-in effect purely looks at the financial reason that people are choosing to stay put. It can be hard to see your current monthly payment of $2,000 jump to $4,000 for the same or a slightly bigger house. And so when this small phenomenon happens at a macro scale of a bunch of homeowners deciding, man, it would be way too expensive for me to sell my home and then buy something else, that creates a macro environment of gridlock. Okay, so the problem is that a bunch of homeowners are looking at the market and realizing that the prices are too high and interest rates are too high, so they decide not to move. And a proposed solution is that you can allow those same homeowners to take their current interest rate with them to buy a new home. And on the surface, it looks like a very attractive idea, right? Because you technically unlock a little bit of supply and you allow people to bring their low payment with them when they buy a new property, allowing them to keep that payment at least slightly lower. However, there's one major problem standing in the way of this change, and it's called the due on sale clause. This is a clause in your mortgage contract that says that if you sell your house, you have to repay your mortgage balance in full at closing. Basically, the term sheet of every mortgage in America says that when you sell your house, you have to pay off that mortgage. And if you're buying a new house, you have to take out a new mortgage. By the way, this is the danger of putting like only 3% down on a house. If you experience any sort of volatility in home prices or just general realtor commission and title fees, you're going to be underwater on your home and have to write a check at closing or take out a separate personal loan to cover the difference. And it's important to note that there are a few exclusions like divorce and death to this clause, but for the majority of home sales in the United States, when a home is sold, that mortgage balance is paid in full. You kind of have to ask yourself, why has this idea just now popped up? Why wasn't mortgage portability like a big deal a decade ago? And that's because for the last 40 years, we've experienced a bull market in bonds driving interest rates lower. So if you've been a homeowner anytime in the last 40 years, if you were to buy a new home, there's a high chance that you could get a lower mortgage rate on that new home than your current one. And if you owned your home for some time and interest rates come down, you could just go to your lender and refinance. But now that we're in a rising interest rate environment, now you have all the homeowners, you have NAR, realtors, all coming out saying that this is a great idea that we need to implement in the US mortgage market. But there are some specific risks for banks and lenders if this regulation were to change. And if someone's able to sell their house and take their 3% mortgage with them, that lender is not able to re-underwrite that risk at a proper interest rate for the current market environment. Also, what happens when you buy a more expensive house or even a house that costs the same amount, but because the balance on your loan is lower, in order to make up the difference on that new purchase, you have to take out a second mortgage. Is the rate on that mortgage the market rate? And if that were the case, which lender would take priority in a bankruptcy proceeding? And although the US would need to work through this change to manage the underwriting risks associated, there are other Western countries that allow portable mortgages. The EU and other countries like Canada and Australia do often allow homeowners to bring their current mortgage with them to a new property. These other Western economies don't have a blanket due on sale clause on their mortgage term sheet because they don't have 30-year mortgages and they don't have the robust mortgage-backed security market that we have in the US. Because in the US, the federal government backstops mortgages explicitly through programs like the VA loan and FHA loans, and implicitly with entities like Fannie Mae and Freddie Mac. Australia, Canada, and Europe don't have that implicit government guarantee for their mortgage market, and you'll commonly see 5 to 10-year variable rate mortgages. But because these international mortgages often stay on the balance sheet of the commercial bank lending them that money, there's a lot more flexibility for them to offer mortgage portability. Now you may be thinking, great, if these other Western economies allow for portable mortgages, we should do the same thing, until you realize that these other Western countries have a way worse affordability crisis than the US. If you look at this map, you can see that in 2025, the US had a median home price to income ratio of 3.3. Now this may seem high until you compare it to Australia at 8.1, Germany at 8.9, and the UK at 8.8. So although home prices in the US are high, it is still much more affordable than other Western nations, even though they have mortgage portability. Now, is mortgage portability responsible for these other nations having crazy high price to income ratios? Probably not. However, I do think that if the US changed banking regulations to allow this, it would only exaggerate the affordability problem. And this is why. This is the third part of the video that in my notes I titled "The Rich Get Richer." The biggest reason, in my opinion, that we should not allow mortgages to be portable is that it emphasizes the current K-shaped economy we're living in. That K-shaped economy benefits the rich equity class and continues to disenfranchise the working class and poor. If we allow current homeowners, which are traditionally Gen X and baby boomers, to keep their 2.5% mortgage and bring it with them on a future home transaction, all that's going to do is continue to prop up home prices. So the elite class is just going to keep pulling the ladder up from beneath them, leaving behind younger generations from participating in the largest sector of our economy and the most important asset that any family can own: housing. And the argument is that we just need more transactions. We need more homes to trade hands to solve this problem and increase supply. And so by allowing current homeowners to take their current mortgage with them when they buy a new home, you're freeing up some supply. But the people that propose this idea are forgetting that the people that have the low interest rate mortgages and are bringing them with them to buy a new home are just selling one home and buying another. It does not add more supply. All it does is continue to prop up prices. All it does is allow the equity class to exchange homes between each other and leaves out the working class. So you may be increasing transaction volume, but you're not actually increasing the amount of available supply on the market. This brings us to a very important markets principle called volume. Whenever you have a rapid increase in the price of any asset, you need volume to follow through to keep that asset price strong. If an asset jumps too high too fast, like for example after a very great earnings call, it can create liquidity gaps in the market that will often get tested to see if an asset deserves those higher prices. Let's take this stock for example. In just 4 months, it went from 70 cents to $6.60, but it's important to remember that markets are a process, not a destination. And when you look at this equity, it has already fallen to around $2 a share. But you see that first big green candle that led the impulse to higher prices? Now look at the right side of this chart, which has the volume profile. The volume during that move was almost non-existent. That means that there were very few transactions that took place at those prices. And right now the chart is suggesting that the market wants to test this area of low liquidity to see if this stock deserves higher prices. So what's happening with this stock is the market is testing that liquidity gap to see if that stock deserves being higher than like $2. Okay, let's take this concept and apply it to the housing market. I showed this chart at the beginning of the video, and what we see is that after interest rates started rising, transactions fell off a cliff. This created a volume gap at these higher prices. And yes, back in 2021, we had high transaction volume while prices were increasing rapidly and peaking. However, the affordability, like the monthly payment, had not peaked yet. That peaked in early 2023. And at the peak of monthly payments, right, when you combine high interest rates with high home prices, you have a very high monthly payment. We've seen a very low amount of volume. There have not been that many transactions taking place at these elevated monthly payments. And so I don't think this is going to happen because the government is probably going to step in and do something. But if the housing market was left on its own to have natural price discovery, I think what we would see is a test of that low liquidity. You'll see housing prices start to go down to see if people are still willing to buy homes at these elevated payments. So I think the market in aggregate wants to test if these are the prices homes need to be at. So naturally, if left to its own devices, you should see home prices start to decline because it's testing the resolve of buyers that bought high and new buyers in the market to see where that natural price level is. So if you allow for this gridlock to happen, people will eventually need to move when life necessitates it. There are so many reasons why people just have to move. Job changes, you got to downsize or even get more space for a growing family. You have to sell a family member's home after they've passed away. And with all sorts of reasons why people need to sell houses, as that natural inventory increases and the buyer pool is not very big at these higher monthly payments, you'll naturally see home prices fall as people are motivated to move their houses. And this, in theory, is the solution to these high prices. It's to allow the prices to remain high without any technical financial engineering to try to tinker with the problem and potentially make it worse. But here's the problem, and the reason why I don't necessarily think this is going to happen, because if this were to occur and home prices were to steadily decline, people would be underwater on their mortgages. And because of that, you'd have increased selling pressure from forced sellers that need to get out of their house for a financial reason. But hey, no one gets bailed out in the stock market when they buy the peak either. And as someone who didn't buy a home with a low interest mortgage in 2021, even though I could have, I'm speaking for half the country that currently rents. We don't have that much sympathy if the price of your home goes down, or that a current homeowner can't afford to move, because we can't afford to move either. Okay, let's take a little bit of a pivot here, and I want to talk about Zillow because they're kind of great at making this problem worse, because home prices are in a sense psychological. People get very attached to the market value of their home, and Zillow hasn't done a great job at helping with this. Homeowners have seen what their Zestimate was at the end of 2021 and still think that it's worth that much when interest rates are 3 times as high as they were at the end of 2021. In my own area, I've seen homes that have been on the market for months and maybe they've dropped the price like $5,000 or something. But after a few months of having very few showings and not selling, these homeowners have just elected to remove the listing. Oh, we'll wait till the spring till we can sell the home for what it's actually worth. But the reality of home prices that so many people can't understand is that a home is only worth what someone is willing to pay for it. It's not worth what that Zillow's estimate says. In fact, this estimate is notorious for being incredibly inaccurate. So if someone lists a home at a high price, let's say a home is listed at $500,000, it's only worth that if someone is willing to pay it at current borrowing rates. If someone's not willing to buy your house, I'm sorry, your house is not worth what you listed it for. But this entire process takes time. If people think that the government is going to intervene to make credit cheaper or somehow keep home prices elevated, then yeah, they'll be able to just kind of wait out the storm and sell their home for what they think it's worth. But if you allow time to work, if you allow markets to naturally work as a process to determine the accurate price level of aggregate prices in an economy to see if that's actually what a lot of these homes are worth. But unfortunately, there probably will be some form of government intervention like mortgage portability that continues to raise the ladder out of reach for millennials and Gen Z. And the reason why this would continue to prop up prices is that if someone who has a 2.5% mortgage, let's say that the balance on that mortgage is like $300,000, if that person can sell their current home at a high price and then go buy a new home, and they can transfer $300,000 of purchasing power to that new home that they want to buy. Let's say they're buying a home worth $400,000 and they're financing 100% of it. They have $300K of purchasing power at 2.5%, and they can just borrow the extra $100,000 at the market rate of like 6%. That means that their blended interest rate is still in the mid 3%, making them a much stronger buyer. And all else equal, they're going to beat out the homeowner that doesn't have that 2.5% mortgage every single time. A quick point here at the end of the video. The current lock-in effect has been a problem for real estate agents. There are over 1 million agents in the US, and the National Association of Realtors is the largest lobby in the United States. And I think that's part of the reason you're starting to see this idea pop up, because these agents have been hurting the last few years. And if transaction volume can increase, they can continue to take their 6% out of each transaction. And Graham at least was a real estate agent, and he's in a network of real estate agents. So it wouldn't surprise me if this idea was being floated around him and he kind of hung on to it like a good good idea. This proposal that allows current homeowners to bring low interest rates with them for future home purchases does not help the general public, most of which do not own homes. It just keeps the rich rich and the poor poor. And so with any proposal, you have to look at the incentives, right? NAR and real estate agents, they want higher transaction volume because they want to get paid. And current homeowners just want to keep their low housing costs. But this will only benefit elite groups who have benefited for the last 40 years, and it will only make housing affordability worse.